What is going on, investors? Back again, another stock analysis. This time looking at one of the more famous companies in the entire world, the Walt Disney Company, ticker symbol DIS. Obviously, the operator of Disneyland, the owner of ESPN, the ABC networks, the popular Disney Plus app that's just recently launched, among other assets that this company owns. Full disclosure, I own a couple shares of Walt Disney, and I have two young kids, so I have the Disney channel on quite a bit during the day. During the regular session, this stock didn't really do a whole lot, just kind of traded sideways. I'm actually interested to see as we jump into the numbers. We'll jump into the numbers, see what's going on here at Disney, and then finally we'll jump over to the chart as well. We've seen here in the after hours, this stock is really trading up kind of nicely, 4 or 5% here, and you got to expect this had to have been a tough quarter. Before we jump into the numbers, you got to expect this was a tough quarter because they had Disneyland closed, Disney World closed, Disney World China was closed for most of the quarter, not all the quarter. They cut their dividend to zero. This is a company that used to pay a semi-annual dividend. They cut that. We're still at a 39 PE on this company. We got $211 billion market cap. Now, 52-week range here is kind of interesting. We dipped all the way down to 79. We've been up to call it 53. So we're a little bit not really in the middle of that range, slightly above it. So investors are giving Disney a free pass. As we jump over to the numbers here, we see revenues here, quarter ended. We got the most recent quarter here, June 27th. We got the previous period again when everything was great and wonderful. Everybody had a job. Everything was open. We see here, take a look at media networks. That's actually held up really well, in my opinion. That's only down 2%. And for the 9-month ended here, we go from June to June, 16% increase over the last 9 months. And we got just a 2% decline. So that's actually kind of interesting. I actually would have expected that, considering you got ESPN with no sports and things like that, and a lot of these networks without a lot of their programming and stuff. This actually held up very nicely. They obviously have other programming that is keeping things afloat, even though you don't have like a lot of movie production and things like that going on right now. Now, parks, experience, and products. Take a look. We went from $6.6 billion all the way down to $983 million. Wow, that's a complete disaster. Obviously, the things were closed. So investors are giving Disney a pass. I would say, there's some people that might say, well, look, the stock should trade down a lot. Well, this obviously, I don't want to say it was priced in, because I don't think a decline of 85% of your top earning business, I mean, outside the media networks, this is their top earning business here, the parks. I don't think it was, it might have been priced in when you were down here at $79, but right now investors are basically giving Disney a pass, and I think assuming that the parks get open, I would guess in the next, I would call it 6 to 12 month window. Again, that's just me guessing, but as long as the parks and products get back up and running, I would guess sometime in the next 12 months, investors will likely just look past the declines because they're expecting it. Now the parks were closed, so they totally expect it, and they expect when they reopen and when it's safe to go, people will return. At least that's what investors are assuming, I think, at the current price. Studio entertainment obviously went down quite a bit as well. You had a lot of movies not make theaters. Theaters are closed. It's just been a disaster for both the parks and the products and the studios. It's just really rough. But again, I think investors are assuming, and maybe correctly, maybe incorrectly, I'll let you decide, but they're assuming this business comes back one way or another. Movie theaters come back open, or they just launch all this stuff direct to consumer. We see the direct consumer international. This ticked up just a little bit. Actually, I think you would have expected this to come up a little bit higher, but it didn't. We see here for the 9-month, it really accelerated tremendously over the 9 months. But quarter over quarter, it seems to me, the people that want Disney Plus or their direct consumer offerings pretty much have it. So that's interesting to see. We see total revenues went down 42%. Again, under different circumstances, if Disney's revenue went down 42%, you'd see the stock absolutely sell off. But again, investors were basically pricing all this in, or at least anticipating it, giving the company a pass. When we take a segment operating income, what's interesting here is we saw that direct-to-consumer didn't really grow. It grew 2%. We see here it's still losing money. So this is a channel that they're not even making money on, and the growth has pretty much slowed. And so that has me a little concerned if you thought this was going to be a big growth, not only a big growth driver, but a big profit driver, at least at the current, the way they're expensing this. Maybe they can cut back on advertising. Maybe there's other things they can cut back on and turn the spigots of profit on, but it doesn't appear to be there at the moment. Still, the most profitable part of the business is these media networks, where they earned 3.1 billion off of 6.5 billion. That's sensational margins. Obviously, with the parks, they're losing money. They off 6.5 billion in the previous period, they made 1.7, and we lost all that money and more went out the window in this quarter. So they're going to have to get these parks back up and going. Otherwise, they will be bleeding money to a certain degree. Now, what I wanted to do, I wanted to show you the segments, because I think that's important with Disney, because they have this media network that's doing well. They have direct to consumer that I would say it's doing kind of well, not from a profit perspective, operating income perspective, but in terms of where they've turned this business into, I guess it's pretty good. And these, obviously, the parks and the movies have fallen off a cliff. Now let's take a look at it from a broader perspective here. We've got revenue here on the top line, quarter and 9 month ended. Take a look. 9 month is actually up. Believe it or not, the last 9 months have actually been up. So that's pretty impressive. And you see just the most recent quarter has been a disaster. So the sooner they can get their parks reopened, the sooner they can get movies back and going, this company can start firing on all cylinders again. We see, let's come down here. Let's just come right all the way down to the bottom line. So we got top line up here, bottom line down here. We had 1.6 billion in the previous period. We had 4.5 billion loss. That's really rough. We see we made close to 10 billion in 9 months. And we lost 1.83 billion. That's not too bad considering the circumstances. To lose 1.8 billion dollars in 9 months, you got to figure they'll probably have I would guess Disney is probably going to have a similar quarter to this. You got sports coming back. The media networks might perform a little bit better. Maybe it's a little bit better than this. They might even provided guidance. I'm not 100% sure, but you got to assume they're probably going to lose money in the next quarter as well. And so they'll end the year with a loss. And so that's a little troubling. And obviously it's probably good that they cut the dividend, because they're losing $2.61 per share. Now, this is a company that is relatively well capitalized. If you take a look here, these are in millions. So take a look. Man, we've got a lot of cash here on the balance sheet compared to the previous period. That's a whole lot of cash. And so this is a company that can survive, quite frankly, several years of losses before it really starts to hurt them. And again, they can start to adjust. Some of the stuff that was going direct to theaters could be adjusted and moved to other areas, like streaming online, and maybe even right to a TV network or something like that. So everything looks pretty good here. Let's see how they handled the liability side. Everything looks good. They have borrowings obviously ticked up. When you see cash tick up this much, this is like that's a lot. This is like $16 million. So that ticked up a lot. So you see borrowings ticked up quite a bit, almost the exact amount that cash came up. So they do have some long-term debt. It's rather substantial, but most of it's sitting on the balance sheet right now as cash. They have some receivables as well. Current assets is at 41 billion, and so they've got some assets here, but they do have some borrowings. And you just hope, as a shareholder of Disney or a potential shareholder of Disney, you hope they clean that up. Now, from a cash flow perspective, everything looked pretty good for the last 9 months, still producing cash. But then again, we see on the financing side, they raised pretty large borrowings, actually. It's interesting. It was actually 18 here, and it was 18 here, and it was 31 in the previous period. So it's actually pretty much flat, year over year. And so, things aren't as bad as I would have thought. And I actually think that's maybe potentially why this stock is trading up a little bit. I actually would have thought this media network wouldn't have held up this well. They actually churned out more operating income from the segment. Take a look. They went from 2.1 up to 3.1, and that revenue actually went down. So they really did a good job driving that. And so maybe they had some levers to pull there, and I don't think they have any levers to pull with these parks. If they're closed, they're not going to make any money on them. But maybe with this studio segment, they're able to pull some levers here in the next quarter, because again, I don't think movie theaters are going to be widely available, at least in the major markets. And so it's possible they did squeak out some money. Take a look at this. They went from 3.8 to 1.7, but they only lost 16% off their operating income. So they're pulling some levers with the studio entertainment, and it'd be interesting to see if they can do that. The other thing to keep in mind is a company like Disney has probably not been doing a lot of filming. So how does that affect the 2021 movies? How does it affect 2022 movies, and so on? And so down the line, it could be that the pipeline isn't as strong in the studio, and you might have to put a lid on these. Now, jumping over the stock chart, again, this stock is trading up about 3% in the after hours, almost 3.25%. And so what we saw here, this stock was in a defined downtrend. I came here, you could have came back here if you wanted to, but I could pick this top here, ran it through this top, ran it through this top, and ran it through the top we just made. The stock was hitting its head on this resistance and could not break. Now, the interesting thing is it just broke this. So if this stock can trade here tomorrow, maybe hold this, I actually think the next stop for this stock could potentially be up here at 127, right in the 127 range, kind of hitting its head on these lows and then hitting its head on this top. For it to break through there, this stock could easily get to 134. You've got a gap here and you've got a gap here. So there's not a lot holding it back from filling those gaps if it gets up into the 130s, 140s. I think we're a little ways away from that. I do anticipate this stock trading up into the 120s and then maybe coming all the way up to 125, maybe to the 127 range, and then maybe pausing here for a second. I could see a newer trend emerging here. But this is a bullish sign that the stock has kind of popped up above this long-term trend line. Again, you haven't seen it pop its head over that in a few months now. And so for it to pop up here and potentially trade up here, it could start a new uptrend. And again, I think it's got some relatively smooth sailings up into the 127s. I bet there's some traders that are probably going to look at that kind of setup as well. So there we go. There's Disney. Overall, probably a little bit better expected. I think still from a valuation perspective, the fact that they erased their dividend, there's still a lot of uncertainty here. For me as already a shareholder of Disney, I think my cost basis is somewhere in the 90s on this one, or maybe the low hundreds. So I'm not really actively going to come in here and jump in here and buy this stock. If it had sold off in the after hours, kind of continued this trend, maybe come down here in the low hundreds, I might have thought about it, because I think at that point you're getting some value. Now when it's priced up here, some things are going to have to go well. They're going to have to get those parks reopened, movie theaters reopened as well, since that's a big part of their business and their operating income as well. So there we go. There's Disney for you. Hopefully you enjoyed that one. We'll be back again shortly with another video. Hopefully you guys are all doing well out there. We'll be back again soon. Good luck with your investments.